Hey, good afternoon, everyone.
Good afternoon.
Yeah, hi, Alicia. Hi, Sapphire. How are you? Okay, I see six people in the collaborate. Maria, are you there? Maria? Maria. Oh, just okay, reconnecting. Mukhtar, are you there? Mukhtar.
Yes, I'm here.
Okay, how are you? Kadir, are you there? Kadir. Ronisha, are you there, Ronisha? So I think Maria is having connection issues, and Kadir and Ronisha unresponsive. That's um, well. So in the discussion board, let's see how many people are there. Okay, I see seven people, so it's almost the same number. Um, but let's see. We're gonna so in our last class, and in the course materials, right? Uh, so we're gonna move on to topic 6 today, but we just need to wrap up what we were uh, doing last time. So in our last class, we basically know how to how we can use the um, normal distribution properties to make our prediction about uh, the future returns, right? Our forecast of returns with probability. In other words, there's a 34% there's a um, uh, between our expected return is our mean return, right? Mean, right? Uh, and our mean return from our Apple's data, it was like almost like 3%. It was like 2.9%, right? And there's a 34% probability that this probability is 34%, that the actual return next month will be within, between 2.9% and our almost 8%, right? Our standard deviation was almost 8%. So this one standard deviation above the mean is like 11 point, almost 11%, right? So in other words, there is 34% probability that our actual return will be somewhere between 2.9% and 11%, right? One standard, and that's, and also there's, that means one standard deviation below mean. So it's like 8% below mean would be something like, 3 minus, so negative, it will be like negative 5%, 5.1%, right? And there's, another 34%. So in other words, we can tell with, probability what our actual future return will be, right? Based on the mean and the standard deviation. Another, once there is also another, 14% probability for the, return to be between one standard deviation and two standard deviations above the mean, which is then like 19%. Another, 14% probability that it will be between, one standard deviation below mean and two standard deviations below mean. Two standard deviation below mean would be like 13%, right? And then negative 13%. So we can tell it with probability, and even the two extreme ends, right? There is 2% probability, 2% probability in the upper tail and lower tail, and that's the probability of earning very high returns, like above 20 something, right? And that's the 2% probability of earning very low, fairly low return, like below something like negative 18%, right? Or anything below negative 13%, right? Such low returns have 2% probability. And if you add up these probabilities, 68% within one standard deviation, right? And then 96% within two standard deviations, right? And altogether, right, that's 100%. That will be 100%, right? Okay. So that's one way we can use, right, the mean and standard deviation and the properties of or characteristics of normal distribution. And another way we can utilize this mean and standard deviation is basically finding the most efficient uh, 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 aligning our stocks or our assets in the order of the efficiency or productivity. Now, so suppose you have $1 million. Let's say, suppose you have $1 million. And if you have $1 million, now think about it. And you want to manage this money. So what do? You would put it into stocks or put it into bonds. But let's say you have decided to you want to put it into stocks. And obviously you want to put it into the stocks that are giving you the highest returns. But that's not the only criteria. We have two criteria. Right? We have two criteria. One, you want to put it into a high return, but it has to be low risk, right? You want to put it into the stocks with high returns, and then they must be also low risk as well. But so you've researched hundreds of stocks, and from your research, you came up with these three stocks, X, Y, and Z, based on those two criteria: return, expected return, or the mean return, and the standard deviation. Standard deviation is the measure of risk, isn't it right? Because it measures the volatility, and the volatility is the risk, right? Volatility of the stock is the risk. How volatile that, right? Volatility. Volatility is the risk. Think about it. Volatility, if the stock follows exactly the expected path, predicted path, right? These returns are predicted path because it's the mean of the past returns. So the reality may not be like that, but most likely it will be that. It will be, most likely it will be the return next month will be like that. But of course, there's a probability. I mean, although the mean is like 3%, but there's a 34% probability it will be between the mean and one standard deviation above the mean. Also, there's a 34% probability that the next month return will be between mean and one standard deviation below the mean, right? And we have, but basically, that's what these expected returns are telling you. So you picked, these three stocks, X, Y, and Z, because they have, highest, a very good highest return. Y has highest return. X 25%. That's not bad. That's really good. 10% is not bad either. But you might wonder, if X is, Y gives you 30%, why didn't you pick another stock that has the return of 29%, right? And why not 28%? I mean, it would be nice if you can find stocks or like giving you 30%, 29%, 20%. But there is another criteria. Obviously, the stock that gives you highest return will also have highest variation, right? Why? Because as the saying goes, the higher the risk, the higher the risk, the higher the return. So in other words, there is no stock that gives you high return but very low risk. That's not. It's only in your dreams, right? That's not the reality. In reality, if the stock gives you a high return, it is associated with high risk as well. So the best you could find was that I mean, if X was X gave you 29% mean return, then most likely its risk was its standard deviation. Most likely it would be something like 50, 58%, 58, whatever, it would be higher. And then if Z was giving you 28% return, its standard deviation would be also like 55% or something. But so we cannot really find things ideally aligned with high return and high risk, high return and low risk, right? So anyway, so you came up with these three stocks. One criterion is return. The other criterion is standard deviation. And if you go by this criteria, if you go by return, obviously this will be your number one, and this will be your number two, this will be your number three. But then you cannot go by only one criterion. You have to also satisfy the second. I mean, if you go by the risk, the lower the risk, the better it is. Isn't it right? The lower the volatility, the better it is. If you go by that, then this will be number one. This will be your number two. This will be your number three. So now you have a dilemma. You cannot go by just one criteria. You have to come up with some compromise of these two criteria. So what you can come up with is mean variance ratio, or actually expected return is the mean, right? So it's called mean standard deviation ratio. Now, standard deviation is also the twins. I mean, standard deviation is a twin of variance, right? I mean, they are like, one twin is, sort of blown up. The other twin is, the other twin is very thin. The other twin is, blown up. One twin is, the life-size picture. The other twin is, a blown-up picture, right? So by using mean standard deviation ratio, or it's also called mean variance ratio. As I said, although this is standard deviation, variance and standard deviation are basically two sides of the same coin. And then also called return risk ratio, because it's return, literally. You're dividing return by risk, right? Therefore, it's return risk ratio. And think about it. What is the meaning of return risk ratio? What's the meaning? It's the output to input ratio. If you think about it, it's output to input ratio. Okay. So what's an output to input ratio? Now think about it. In a good example of output to input ratio is gas mileage, right? And gas mileage is clear, how many miles per gallon. But so per 1 gallon of gas, how many miles can your car get? And the higher this number, the higher the gas mileage, the better it is. Why? Because that means your car is more fuel efficient, right? Another way of, but how do you calculate this? Of course, it's simple. If your car has 20 gallons, if your car has a 20-gallon tank, right? You fill up your car, drive until you run out of gas. Then, if your car got 800 miles on 20-gallon tank, then the gas mileage is simply 800 divided by 20. So that is 40 miles per gallon, right? Obviously, 40 miles per gallon is really, really good, right? Uh, uh, it's very fuel efficient cars will get that. Even 30 miles per gallon. I mean, if the car has a big engine like V8, 4.8 liter V8 or 5-liter V8 engine, even 30 miles per gallon would be a very high fuel economy, right? Very good fuel economy. Okay, I had to take a little. I had to catch breath, and because I'm getting uh, I'm getting dizzy, actually, lightheaded. Speaking, uh, I just had another class, one class before this one, and I guess I'm completely exhausted from speaking for a long time. Also, the same. So basically, it's output to input because miles run is the output, gallons gallons used, that's the input. And also another example of output to input ratio is um, how much money you can make, right, after graduating from college. I mean, think about it. If you CUNY is a very CUNY is a school that gives you a very high output to input ratio. Isn't that right? because uh, uh, one student told me before that one semester tuition for CUNY at one semester is not even like $3,000. Uh, roughly, let's say $3,000. For a year, it's not even $6,000. I don't know what tuition is at BMCC per credit. Is it like $100 per credit? Does anyone know? Okay, we have Ronisha. Are you there, Ronisha? Tia's there too. Check your
Honestly,
microphone?
I don't know.
You don't know? You don't know how much you're paying per credit?
No, I get
Ronisha,
financial aid.
hmm? You get financial aid. Okay, anybody knows, how much you pay per credit at BMCC? I think you're paying like $100 per, I don't know. According to the student who told me, if you're taking a full load per semester, full load is, like 6 classes, 18, then, three credit, so 18 credit per semester. So let's say full time is anywhere between 4 courses to 6 courses per semester. So if you're taking 4 courses, that's 12 credits. And if you don't pay, even if you take 15 credits or 18 credits, you don't pay any more. You just pay for 12 credits. So if it is 3,000 was just rough, right? As rough, estimate. But let's say, so I think you said 2,800. It's not, 2,800. Let's say divided by 12 credits. Still comes to $233. Did I do it right? Maybe 2,600 divided by 12 credits. Yeah, so it's about $200, I guess, per credit. I don't know if this was, if I remember it correctly. It cannot be $200. It would be below $200. But I don't know. You may be paying $150 per credit. So $150 times 12 credits. Yeah, that looks more like it. $1,800 per tuition only, right? Let's say that's $2,000. Then think about it. At BMCC, if you take full load, classes full load, then in 4 semesters you will graduate. So it's like $8,000 for 2 years, tuition alone. But what else do you pay? I mean, other than tuition alone, uh, just something like student association fee, or and then student health insurance. It won't be more than $2,000 per semester, right? So it's $4,000. So 8,000 per year, $8,000 per for 2 years, or at best $10,000 for 2 years. So and in even in 4-year schools, it won't be that in CUNY school, CUNY colleges, it won't be that much different. So even over 4 years, you are not paying more than you will be paying at most, $20,000. But in private in state universities, still you will be paying at least like $20,000 a year. Over 4 years, that will be $80,000. Private schools, you'll be paying, anywhere between 40K to 50K a year. For 4 years, that's going to be 160,000 to 200,000. So then, that's the input. And when you graduate, let's say you get, let's say you graduate with, business degree from Baruch, Zicklin School, and you paid only about $20,000 over 4 years. But once you graduate, you will most likely, your startup salary will be at least something like 60K, at least something like 60K. So it's not a difficult thing to find, input-output ratio here. It's clear that the CUNY gives, best mileage, right? So output to input ratio is like a mileage, gas mileage. 60K just in the first year, and over 4 years you paid 20K. You made, you have already, your education already paid for itself. Your CUNY education has already paid for itself, and 3 times, paid for itself 3 times, it will still give you, a 40K left over just in the first year. But if you graduate from Ivy League schools, you'll get probably, better than 60K, maybe, 70K or 80K, but not more than 80K. I mean, you have to be really from a really, really good school, like Harvard, MIT, or Yale, Princeton, Harvard business degree. Most likely, maximum you will make, college graduate, just, it's not like you can make, on average, you will make anywhere between 60 to 80K, at best. So it won't be that much, that much difference. Then, over 5 years from Ivy League schools, it would be like maximum would be like this. Okay. So then you can tell what is the input out, what is input output ratio, right? You cannot even recover this. You will be able to recover this in 4 years, right? Of course, depending on what kind of, let's say you work for an investment bank. Most likely, you work for an investment bank. Most likely, you can make $100,000 at least $100,000 just out of college, or more than $100,000, $150,000 even just out of. But then you have to be really, really from a good school, and then you don't have a life, right? You work like 16 hours a day, 16 hours a day, 6 days a week. But even if you make a lot of money, you can't really enjoy it. On Sunday you're busy just sleeping. You have to make up for the loss of sleep you had. But anyway, it's the same concept, right? Output to input ratio. The output is the return. Risk is the input. You have to take this risk to earn this return, right? So the risk is the input, return is the output. So just like the gas mileage, if you take this ratio, the higher the number, the better it is. Now then, if we take this ratio. This is your number 1 stock. This is your number 2 stock. And this is your number 3 stock. Right? So this conflict is now resolved. We reconciled this, different ranking by, two different criteria. Now, although mean variance ratio or return risk ratio is quite, intuitive, because it's, logical and intuitive as well, and because it's like gas mileage. But the textbook is showing you, telling you what they call coefficient of variation. And what is the coefficient of variation? What is this? This is return risk ratio, but then raised to -1. What is that? That's the reciprocal. So coefficient of variation is the reciprocal of the mean variance ratio, or return risk ratio. In other words, it's the so then if it is reciprocal, then the lower the number, the better it is. We still arrive at the same conclusion. This is the lower the number. So still number 1, number 2, number 3, right? So this is the ranking. We can rank our stocks this way, and then also allocate our money. We have $1 million. So we can allocate the most of that $1 million into Z, second most amount into X, and the least amount into Y. Okay, and then another thing is, so why do they use the inverse ratio then? Coefficient of variation is the reciprocal of. Why do we use the reciprocal? Gas mile in other countries, in the US, we are used to miles per gallon. But in most other countries, they use inverse gas mileage, which means how many liters were used to run a kilometer, right? So it's liters per kilometer. Of course, you don't use 1 liter to get 1 kilometer. Actually, you will get by burning 1 liter, you will get many kilometers. So actually, this ratio will be less than 1. It's between 0 and 1. It's like 0.03 liters to get 1 kilometer. The lower the number, the better it is. But why do they use inverse gas mileage in other countries? Well, it's because in most other countries, petroleum is a very scarce commodity. Most other countries don't have oil reserves. They are not oil producing. US is very fortunate, very lucky. US has a lot of oil reserves, not only within the continent, but also in the offshore seabed, right? Which is called, shale. What do they call it? Continental sea floor or something. I mean, there's a lot of oil reserve, oil underground, right? And there has been a lot of controversy about fracking. Fracking is what? It's a way of drilling oil, pumping out oil, but they use I believe they use pressurized water to do that, and it causes environmental hazard. So in many places, fracking is banned. And another thing is, U.S. has I would say more oil reserve than Saudi Arabia. But then you might wonder, so why is U.S. importing oil? U.S. imports a lot of oil, although U.S. has a lot of. It's two reasons. One, it's conservation. One reason it's conservation. It's environmental. Two, it's cheaper to import oil than produce oil within U.S. And probably fracking is the only economical way, but fracking is environmentally bad, so they don't. Very little fracking is being done in the U.S. I'm sure you heard about fracking. So think about it. Since in the U.S. we live in an environment where we have plenty of oil, supply of oil, and even since the pandemic and recently, oil prices, gas prices gone up a lot because of supply chain issue. But no other country. I mean, U.S. still has cheaper gas price compared to Europe or East Asia. So even $4 per gallon, it's just like $1 per quart. 1 quart is like 1 liter. 1 quart is almost 1 liter. And in most other countries, they pay like $2 per quart, 1 liter, $2 per, or more than $2, almost anywhere between $2 to $3 per liter, which is a quart. So that means still in most other countries where they don't produce oil, where they don't have oil, they are paying almost twice the gas price, twice for gas, than U.S. Right? So that's something why that explains why they use inverse gas mileage, because for them gas is a precious commodity. Okay. What I did here is, this is weight. Okay. So how much weight do I put into these stocks? This is, I did it mechanically, in a mechanical way, it's a nice mechanical way to allocate in a decaying pattern, the most into a number one stock, second most in number two, and in a nice decaying way, right? This is what but you don't, it doesn't have to be necessarily like that. The point is, you would allocate the most weight into number one stock, second most weight, okay? All righty, so that wraps up everything about the part one of risk and return. We're going to come back to part two of risk and return after we finish stock valuation. Now the time is 2:41. Let's take a 10-minute break and come back, and we'll move on to topic 6, stock valuation. Okay, so let's take a 10-minute break. All right, we're back. We're back. So now we're gonna. Okay, so I'm gonna have to close this. So we're moving on. We're moving on to our next topic, which is stock valuation. So let's see if you guys are still in there. So I have 11 people in the collaborate session, and I did that too soon. Let me check the discussion board. How many are there in the discussion board? And so 13 people in the discussion board. So 2 people are missing. And you guys may, I have posted these things in the, I don't know if you have noticed, but there's a way I can check, how who was logged in actually and how long they were logged in. Of course, it doesn't make, even if you're logged in and if you're away, there's no way I can check. But for example, April 28th, April 28th was last Thursday, so it was 1 hour 40 minutes session. Where's my cursor? So people are, if you're fully logged in, yeah, there will be 1 hour 42 minutes, 1 hour 32 minutes, and something like that. But interestingly, here, Nikri was only logged in, for 11 minutes. I don't know what, she got disconnected or he got disconnected. I don't know, but there's a way I can check, right? So it's just not very convenient to use it because it's not in alphabetical order, not in the. It's just by the time in the order of the time they logged in. So I cannot. It's just cumbersome to me uh, to match it with the to check it in the order of the roster. But anyway, there's a way I can check. So we're into stock valuation. So there are 3 files. One is PowerPoint, the other one PDF, and of course Excel file. We're gonna need this Excel file later. We're gonna be using PowerPoint this time, so please download that file. And I have already downloaded it, so it's here. I'm gonna. Okay. So a lot of things about stock. I mean, not a lot of things. Some fundamental stuff about stocks. We talked about it in part 2 when we did financial statements, right? At the time, you will. So should I? I think I should open. The whiteboard. I'm gonna give it some time because it's gonna take. And you should remember that stocks are equity, okay? And then both debt and equity are both debt and equity are capital components, two capital components uh, that make up total assets. And debt is most of the times you raise debt capital, right? So they are capital components, right? And the capital will make up total assets. Debt comes mostly from bond, sale of bond, right? That comes from mostly from the sale of bond. And some of the debt is from the loan from the bank. But a loan from the bank is sort of like a private placement, right? You privately secured this loan from a lender. However, bond is borrowing from public, right? Large number of lenders, right? Whereas equity equity capital is raised through sale of stocks. Of course, it comes from two sources. So let me. One is, sale of stocks, which is, called, of course, if you sell stocks, then they pay. So those who bought stocks will pay the price for the stock. So the money comes into the company. So that's called paid in capital. Paid in capital. Otherwise, it is, EAT or retained earnings. Retained earning. Which is, and we talked about this in topic 2. This is EAT's net profit. Retained earning is net profit left after paying out dividends. So EAT is net profit is equity in terms of nature of capital. Why? Because you didn't borrow it, and the company owns it. So it's basically it's not paid in capital, but is equity generated by operating activity. Generated by operating activity. Now the choice of color for the pen for inking was not very good, but I think you understand what it is. So equity actually breaks down into common stock and preferred stock. But actually, preferred stock is generally, although it is equity, it is not exactly considered equity. And common stock is the true equity. Common stock is considered as true equity because think about it. True equity, because equity means ownership, right? Ownership, to any ownership, there should be voting right. I mean, you have to exercise ownership. How do you exercise ownership? You have the right to do whatever you want with, but you are not the sole owner. You're not the only owner. There are uh, thousands of, you are just a part owner, right? The ownership of a company is shared by uh, hundreds of thousands of shareholders, right? So in that sense, common stock is the only true ownership because it is paid in capital. Because the paid in capital comes from the, common stock comes from the paid in capital, and equity comes in from sale of common stocks, and only common stocks, uh, people paid, not, I don't like to use the word people because it sounds like only uh, people, human beings. But in the market, you understand that there are institutional investors and individual investors. So people sounds like only individual investors, but actually that means not only individual investors but also institutional investors. A lot of equity comes from uh, institutional investors, right? And of course, um, common stock, so preferred stock is not exactly considered equity. It's almost, it's called quasi debt. Quasi meaning, it's Latin for, almost debt. You know, so common stocks can be privately owned or, closely owned by some group of investors, or publicly owned. Uh, so it can be privately owned, closely owned, or publicly owned. What that means is, think about it. The companies that are traded in the stock market, stock exchange, right? And traded in the stock exchange are basically publicly held companies or publicly traded companies. And what that means is, what does that mean? What it means is that the ownership is open to public. The ownership is subject to trading, right? You can buy and sell ownership. Um, so think about it. When Apple went public, it's been a long time, but when Tesla went public for the first time, it's called IPO, right? When company goes public for the first time, it's called IPO. Maybe I maybe this. When they go public for the first time, it's called IPO, initial public offering. And then after the IPO, then the stocks are basically traded in the market, meaning at IPO, it's called primary market. IPO is primary market. The company sells stock to the public for the first time. And after that, the stock is traded between one investor and another. Okay, that's called the secondary market. Okay, maybe it's easier to use. It's going to take. Okay. So primary market. IPO is primary market because this is where company sells stocks to the public. And in the secondary market, after that is secondary market. In the secondary market, the trading happens between public and public, right? So before going public, right, the company is held privately, right? Only so privately held companies are usually startups, and once the company becomes once the company becomes ready for going public, then investment banks investment banks work as a broker to float this company in the market for IPO. Now, investment banks, it's called underwriting because investment banks underwrite this IPO and they make fees from this. And it will be huge fee. Usually, it will be some cut of the money generated from IPO, and that we're going to be talking about that later. And then, how do you know if the company is ready for IPO? There are certain milestones set by the investment banks. So if the company has met those milestones over the years, right? The company has met, a milestone here, something like, the company reaches, like $5 billion revenue, and year two, $10 billion revenue, et cetera, et cetera. Market share of, 5%. Certain, milestones have been set by the investment bank, and if the company meets those criteria, then, and of course, this is so until IPO, right? Until IPO, the company is privately held, and while it is privately held by whom? Privately held by obviously one, the founding member, founding owner, right? Or the founding, like, if it was Apple, it was, Steve Jobs and Steve Wozniak. But obviously those guys didn't have money, right? How can they grow the company when they don't have? Well, they get helped by if they are lucky enough to be spotted by venture capital, right? You know what venture capital is, and also called angels. It's not venture capital. They are not really an innocent angel. It's just called angels because they come. They appear to the company that is in thirsty, that is in dire thirst for capital, and then they invest capital. So, like an angel that lends a helping hand, in the moment of at the moment of need, really, dire moment of need, dire moment, at the very moment of dire needs, right? So these are basically then stockholders while the company is privately held, because held by these and obviously the purpose of venture capital is to make this company go public, because when they go public the stock price goes up, usually very drastically. Why? Because if this is a very promising company, right, at IPO, there will be a lot of demand. Think about it. Going public, by going public, the company is tapping into, the company will be tapping into the company will be tapping into a huge public funding source, right? When they are held privately, they have limited funding source. I mean, what venture capital has invested, that's all, right? And if there's, if the venture capital invested, $5 million, that's already still a very big uh, uh, risk. It's an adventure. It's a venture capital, so they are on an adventure in a way. They're taking the risk. So 5 million will be the maximum. And the venture capital doesn't have unlimited, infinite resource, right? They cannot invest like $10 billion or $100 billion. They cannot. But by tapping into the stock market, which is a huge public funding source, right? They can raise more capital. So that's oops, what happened here? That's what IPO is. And stocks pay dividends, of course. Stocks usually pay. I said usually. It doesn't mean that. So obviously that means some companies don't pay dividends. That's true. Dividend is not an obligation. It's not a must. Okay, dividend is not an obligation. And I've been telling you this over and over. Coupon payment on the bond, in other words, interest on the bond, is a legal obligation, because if you borrow money, you have to pay interest. It's a legal obligation. But dividend is not an obligation. Why? Because dividend, where does the dividend come from? Anyone?
From the interest.
From the interest? No, interest is what the look. Interest is what the borrower pays to the.
Sorry, I was in the profit. Sorry.
You were what?
I was in the profit. The profit.
Yeah, of course. Dividend comes from. It comes from the profit, net profit. Okay. Net profit is another name for net profit is EAT, isn't that right? Earnings after taxes. Okay. So who said that? Mukhtar, isn't that right?
Yeah, Mukhtar.
Okay, Mukhtar. So you're getting 0.5 for that answer. Yeah, net profit is EAT. So dividend comes out of EAT. So that means only if you have positive profit, you can pay dividend, right? Only if the company has a positive profit. If the profit is either zero or negative, There's no way they can pay dividend, right? So that's why. That's why. Okay, and then that's why dividend is optional. It's not mandatory. Another thing is, so since it comes from EAT or net profit, so after paying out dividend, right? Whatever is left, what's left after paying out dividend is called what? What is it called? After paying out dividend, whatever is left is called what? Anybody? I believe I have like 12 people logged in. No, nobody can answer this. It's a shame. I have 11 people here. Nobody can answer that. Anyone? Any idea?
Maybe income.
Who said that? Income? Who
Top
said
line?
that? Sapphire?
Yes.
No, I'm sorry, it's not income.
Okay.
What is income? Income is your revenue. We're already, we're already at the end of the semester, and this is something you did long time ago.
Can you repeat the question, Professor?
The question is, are you looking at this? I mean, dividend comes out of profit, right? So after paying dividend, whatever is left after paying dividend, what's left, right? There's something left after paying dividend because you don't pay out all of your profit as dividend. Dividend is only something like 10% or whatever percentage. It could be X percent, right? Don't think it is always 10%. 10% is just an example. It's X percent of EAT. So then obviously after paying out dividends, something will be left. So what's that called? Something left after paying dividend. What's it called?
Are you talking about the retained earnings?
Yes, it's retained earnings, of course. It's retained earnings. Huh? Why can't you? Yes, I'm talking about retained earnings, but I mean, the answer should be just it's retained earnings or it's called retained earnings. You don't have to check. You don't have to ask me, are you talking about retained? That's unnecessary. I mean,
My Wi-Fi is breaking up, Professor, so sometimes you go in and out for me.
Oh. Okay, so
So I just want to.
Yes. Yeah, I'm talking about retained earnings. I mean, you have connection issue, right? Yes, it's called retained earnings, right? It's called, and literally that's what it means, EAT, because this is what earnings. EAT is earnings after tax, right? Earnings after taxes. So that's an earning. From earnings, you pay out dividend. So whatever is left is called retained earning, right? And that semantically, that makes sense. Semantically, it makes perfect sense. So again, dividend, and who said that? Who gave me retained earnings?
Claudia.
Was it Claudia?
It's Claudia? Yes, Professor.
Okay,
Claudia.
good, Claudia. Claudia, you got also 0.5, Claudia. And this is section 1401. And today is 0505. All righty. So that brings us back to our back to the dividends. Dividends are not mandatory, and is some percentage of the profit. Usually, so theoretically, dividend is dividend is supposed to change with the net profit. Okay, dividend is supposed to change if it is 10%, right? Just like here, as if dividend is 10% of the EAT, and if as the EAT goes up or down, right? As the net profit goes up or down, then this will also have to go up or down, right? But if you look at the data, and you must have noticed it when we downloaded Apple's data. A dividend is paid quarterly, right? And then from Apple's data, you may have noticed that the dividend was only like 23. What's going on? Dividend is only like 23 cents or 22 cents or something like that, or sometimes at 25 cents. In other words, that's very it looks very immaterial. 25 cents per share, 22 cents per share, and quarterly. So that means a year, right? The dividend for a year would at best be something like $1, right? $1 per share. But if it is annual dividend, and looking at the past 5 years, when we downloaded the data, we were able to see what the dividend Apple was paying. Over the 5-year period, the quarterly dividend didn't change that much. Just about 23 cents, 22 cents. And over the past 5 years, Apple's growth was, monthly, it was about 3%. So over 5 years, it would be about, 450% growth. I mean, while the company grew 450% in earnings, right? Earnings, in other words, profit grew, like 450%. How could the dividend stay almost constant every quarter? That really doesn't make sense. So actually, we come to the conclusion. Theoretically, although theoretically, dividend is supposed to go up or down with profit level, because there's some percentage of profit. Although that is theoretically so, in reality, it has nothing to do with the of course, it has something to do with profit. If, as I said, if there is no profit, or if the profit is negative, you can't pay dividends. But the point is, they are actual dividends are not very highly correlated, not very much correlated with the actual profit level, but they are only token amount. It's only a token, right? What does that mean? It's just symbolic. So the actual role of dividend is nothing but a signal. It's a signal that the company is profitable, right? And of course, even $1 profit annually, $1 profit. I mean, if you have 100 shares of Apple, it will be $100. If Apple pays, $1 dividend a year, it will still be $100. $100 a year isn't such a big deal. I mean, if it is $100 a week, that sounds great. But they don't pay dividend a week. I mean, but if the number comes to like $100 a week, by dividing it by 52, if it's weekly $100, multiplied by 52, that's like $5,200, right? A year. It will be not bad. But again, it's a game of it's a game of large numbers. Now think about it. If you have 1 million shares of Apple, if you have only 100 shares of Apple, $1 won't mean much, because it's only $100 a year. But if you have 1 million shares of Apple, $1 dividend a year is $1 million, right? That's a huge income, huge investment income. And think about it. So these dividends are basically a main source of income for large shareholders. If you're a majority shareholder or very large shareholder, if you hold like 10 million shares of Apple, 10 million shares of Apple. Of course, individuals, hardly any individual would be holding 10 million shares of Apple, but institutional investors will be holding like 10 million shares. And then even if the dividend is just $1 a year, and that's $10 million a year, right? And institutional investors are basically, companies, right? Businesses, companies, and also the law gives them a lot of benefit, because if company A holds, if company A owns like I forgot the exact percentage, but if company owns a large percentage of company B, right? Only about 30% of that dividend income is taxable. And if that ownership exceeds certain percentage, only 20% of that dividend income is taxable. So if you're an institutional investor and if you hold a large amount of this Apple's shares, then like $10 million shares, and dividend is $10 million a year, you pay taxes only on 20% of that. You get 80%, $8 million tax free. So this is really a game of large numbers, right? One interesting thing about one interesting thing about dividend. When we say dividend, usually means cash dividend, but sometimes they pay dividend in additional shares of stock or in merchandise. But this is not a good thing. Obviously, paying a dividend in additional shares, that's not a good thing either. Why? Because if you pay dividend in additional shares, it lowers the price, book value per share. It lowers the price of the stock. It dilutes the price of the stock. It dilutes the price of the stock. So I'm going to explain why in the next class, because we are, of course, out of time. And then paying dividend in merchandise. This is, think about it. Suppose Samsung is paying dividend in merchandise like refrigerator. That is, ridiculous. I mean, for every 100 shares, they are paying dividend in merchandise. First, what does that mean? The company is having a cash flow issue. Why can't they pay dividend in cash? Obviously, the company doesn't have money. They don't have cash flow. 2, this could be one pathetic way of unloading their unsold inventory, right? First of all, if they pay dividend in, if they have piled up, they have unpopular items piled up, so they want to unload it, as if they are paying dividend. They give away these unsold inventory. But first of all, if you are getting a refrigerator as a dividend, so you have more than let's say you have 300 shares of Samsung, and for every 100 shares they are paying so then you are entitled to 3 refrigerators. My God, how are you going to pick it up? It's gonna be a headache. And even if you pick it up, what are you gonna do with that? I mean, you have already probably 2 refrigerators, and you don't even need another one. You'll have to sell it off. How are you going to sell it? How are you going to sell it off? There's a marketplace, like I know in Facebook they have marketplace. Maybe you're going to post it there, or in some online community you're going to post it there. And then if it is auctioned off, how are you going to ship it? It's going to be a hell, right? So obviously not a good idea. So I'm going to talk about stock dividend next time. And I told you this is going to only dilute the stock price. So not so many, they are not welcomed by the shareholders. All right. So that's all the time we have. Any questions so far? Any questions? Mukhtar, do you have a question, Mukhtar? No? Your microphone is on. I would take it as no, because nobody is responding. I will take it as no. So I will stop recording. And so have a great afternoon, everyone. And we'll see you next Monday. Okay? I'll stop recording.
Thank you,
And,
Professor.
all right. Take care,
Thank you,
everyone.
Professor.
All right. Take care, everyone. Stop recording and sign out.